Working capital is one of the most important yet misunderstood elements in tech M&A. It impacts valuation, purchase price adjustments, and negotiation outcomes. Understanding how buyers evaluate and adjust for working capital is key to achieving an optimal deal. Working capital is calculated as current assets minus current liabilities. It represents the cash buffer needed to operate the business day to day. In tech M&A, definitions vary, so aligning early on what counts as working capital is critical. Buyers determine which accounts count toward working capital. Cash is often excluded, while items like accounts receivable, accounts payable, accrued liabilities, and prepaid expenses are typically included. SaaS companies also face unique treatment of deferred revenue. Working capital fluctuates due to seasonality and company growth. Averages don't always reflect reality. Sellers should provide a historical analysis to show true operating needs and avoid unfavorable assumptions. For example, an e-commerce company may need to hold large inventories in Q4, while in other quarters the working capital need is far lower. To normalize working capital, buyers often average the last 12 months of current assets and liabilities. In this case, the average net working capital is $177,701. This becomes the target level expected to remain in the business at closing. Using an average smooths out seasonality, but may not reflect the company's actual operating needs. Working capital becomes a critical focus late in the diligence process. Buyers typically prepare and present their net working capital analysis first. Sellers usually prepare their analysis in parallel, awaiting the buyer's analysis and proposal. The result is a negotiation over the peg and excluded items, with deferred revenue often being the most contentious. Finally, at closing, the transaction concludes with agreed working capital adjustments. Working capital differences adjust the final purchase price. If actual exceeds the agreed peg, sellers benefit. If it falls short, buyers adjust downward. In this case, working capital added $27,000 to the seller's net proceeds. After purchase price adjustments, escrow, debt repayment, and fees, the seller in this example netted $9.97 million from a $13 million transaction. This illustrates how working capital directly impacts seller proceeds. Sellers should prepare early by reviewing their balance sheet and forecasting true working capital needs. It's also important to separate out excess cash so it isn't included in the deal and ensure normalized calculations reflect actual requirements rather than past practices. Negotiations don't always end at closing. Even after the deal is signed, working capital adjustments may continue as actual balance sheet numbers are reconciled against earlier estimates. Buyers often push to recapture value during this stage, so sellers need to anticipate these adjustments and be ready to defend their position. To conclude, there are 3 key takeaways. First, complexity matters. Balance sheet negotiations are often more challenging than enterprise value discussions. Second, preparation is critical. Detailed review and trusted advisors ensure optimal outcomes. And finally, negotiations continue. Post-close adjustments may still be revisited, so preparation avoids surprises.